The U.S. labor market bounced back in March and added 178,000 jobs. In January, they added 168,000. In February, they lost 133,000. That brings the average to 68,000 per month. Looking at the breakdown, and like usual, healthcare was responsible for much of the growth. That sector added 76,000 jobs, and construction and transportation also added. Federal government jobs and financial activities lost jobs. You can see that AI has been consistently taking jobs away, especially those in very repetitive work or non-essential services. Whereas those that really need hands-on human beings, they're the ones that are still growing. Unemployment level dropped a little to 4.3%, but that's because there was a decline of 396,000 in the labor force, and the share of working-age Americans in labor force dropped to almost 62%. That's the lowest since November 2021, and 64,000 fewer people are holding jobs now. Wages increased at a slower pace, at 3.5% year-on-year. So the summary is job creation remains concentrated in sectors that I mentioned, those that need human beings more. And employers are hesitant to accelerate hiring plans, given that there's so much going on right now. Looking at the labor market as a whole, fewer jobs are needed to keep the employment picture stable now. This is very likely because of AI underlining it. St. Louis Federal Reserve estimated that as little as 15,000 jobs are needed to keep the unemployment rate steady. So while this isn't good for individuals, but when you look at the investment market, this is something that businesses will benefit from. And next, on to interest rate. There's virtually no probability of a cut in the upcoming Federal Open Market Committee meeting on April 28th. The recent high oil prices because of Iran war will start to drive inflation level upwards, and the Fed can't risk having the likelihood of inflation moving even higher. Trump's Liberation Day happened on April 2nd, 2025. It's been a year since. For some background, at Liberation Day, Trump imposed very high tariffs on imports on many trading partners, such as China, European countries, and more. Then, the U.S. Supreme Court said Trump doesn't have the authority to impose such high tariffs that he imposed via IEEPA. Trump responded with a 15% universal tariffs under Section 122. He also launched Section 301 investigations, which looks at trading partners for unfair trading practices. The countries are China, European countries, Japan, Switzerland, India, and more. That will pave way to impose more duties. Investors diversified from American returns because of how volatile U.S. policies are. Some international markets outperformed S&P 500. Look at the chart on the right. But South Korea mostly benefited from the semiconductor boom, and Japan benefited from the new leadership in the government. The key point here is what I've been advocating. Pick sectors that align with policy tailwinds and avoid those that are exposed to trade disruptions, such as companies that sell physical products to the U.S., and those that rely a lot on importing and then exporting their manufactured goods. Favor companies with products and services that align with domestic production, such as those with consumers that are mostly domestic, and companies that are aligned with AI trends and energy security. All of these are attracting capital from investors. On the other hand, companies with complex supply chain are obviously facing higher scrutiny. Some even have valuations compressed. This has always been a better approach in picking your investments rather than saying that the U.S. market is better than the European markets or Asian markets. That's not the case. Always pick sectors that are aligned to the flavor of what's going on in the world. But it's just so happened that many companies prefer to be listed in the U.S. market, such as NASDAQ or New York Stock Exchange. That's why the U.S. market has a history of performing well. On to a quick update. Trump threatened to destroy Iran's bridges and power plants and said the U.S. military will hit Iran extremely hard for the next 2 to 3 weeks and bring them back to the Stone Ages. And about a week ago, Trump issued the 15-point peace plan proposal, and obviously Iran said it's extremely unreasonable. Iran has been attacking its neighbors, the GCC countries, Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and UAE. These countries then called on United Nations Security Council for help and immediate cessation of Iran aggressions. The U.S.-Iran war will continue to go on, and we'll see what will happen. For a quick overview, North America is the world's largest oil-producing region in 2025. They generated close to 32 million barrels per day. That's almost 30% of the global supply. The next biggest area is just a little lower at 29.1% of global share, and that's the Middle East. You can see why, broadly speaking, two main reasons the US is attacking Iran. One is because of the oil share, and the other, some are saying it's because of Israel's expansion plans. More importantly, let's look at the thoughts on the investment market. Most very well-established financial institutions are saying the same things. Let's zoom into Morgan Stanley's. So, while oil is the main topic now, a recession only occurs when earnings growth is decelerating or outright negative. But today, earnings growth is accelerating and running close to 14%. That's a very comfortable number. And the forward-looking forecast from analysts is about 20+%. And the magnitude of oil move comparing year on year is only about half of the times of recession outcomes. So, markets aren't pricing in a recession because the odds are low right now. Instead, markets are pricing in continued uncertainty about oil and other key resources. Hence, it's always good to stay fully invested. On the right, this is a comparison across a 20-year span period, 2006 to 2025. When you miss the respective best days, these are the changes in your annual average return. In fact, some downward swings actually created even greater upward gains. And this is an overview of the major events that brought oil prices high. Current levels aren't as high as the previous few. So we find ourselves in almost similar position to last year, with major indexes selling in early of the year, February and March. But back then, last year, the concerns were centered around tariffs. Equities in April 2025 were pricing in a recession. Look at a chart on the right. That's when the S&P was down 20+%. But this time around, many don't expect this year's drawdown to be as bad as last year. The key reasons are these. The current backdrop is much better than last year's. Hence, earnings and economic growth are going well. Let's look at interest rates, too. Interest rates today are lower than those in 2025. The US in 2025 was at 4.5+%. In Euro area, it was 3+%, and China was above 3%. Next, fiscal support is much greater. Income taxes in the US are lower now. There are more tax refunds for personal and corporates, and Trump's one big, beautiful bill where the tax incentive should drive higher capital spendings in companies, which means expansions. And then Fed's asset purchases are more accommodative than last year, where they actively shrunk their balance sheet. This means there will be more liquidity in the market. Whenever Fed buys from the open market, primary holders can offload and enter into new positions. Typically, these are treasury bills. The bottom line is equity markets have been digesting what has been happening, and Morgan Stanley feels that we're closer to the end of the correction. Euro area inflation jumped to 2.5%. This is widely expected. The energy component of inflation jumped almost 5%. This is mostly related to the Iran war. European countries are net importers of oil and gas. They rely a lot on other countries for oil and gas. The European Central Bank President, Christine Lagarde, mentioned that they'll very likely respond to interest rate hikes, even if the surge in inflation is short-term. Because of Iran war, sentiments and confidence levels are brought lower, and Europe is particularly vulnerable to energy price shocks. They're very reliant on oil and gas imports. Looking at the same thing that happened in 2022, that's Russia-Ukraine war, inflation level hit the highest in 10 years at 10.6%. This time around, it's almost the same thing. Back then, the triggers were Russia-Ukraine war, and oil prices were already under pressure before that war because of the rapid post-pandemic recovery, bad weather, delayed maintenance because of COVID, weak supply chain also because of COVID, and low investment in oil and gas sector and in supply chain sector too. Look at the extreme right. In terms of volume, 2022 is the one in light blue. It's not that far from 2023 and 2024, the one in gold and mustard. But then when you compare the pricing and value, 2022, which is the one in light blue, was much higher because prices were very high due to the two main triggers. And so, given that European countries are very sensitive to energy price shocks, that's why their inflation level jumped that high. AI in China is growing rapidly. Firstly, large language models like DeepSeek are no longer enough. Now they're focusing on industry-specific AI to further boost the alpha of each industry. There are also a lot of patents for sale, the intellectual property, It's almost like an international technology trade, which will help in expanding the global outreach. Then, Chinese semiconductor firms reported record revenue because of high AI demand and shortage of memory chips, and also U.S. export restrictions on China. This helped the homegrown Chinese tech and tech-related industry move up very quickly, and analysts are expecting further revenue surge this year. Some examples are Semiconductor Manufacturing International Company, China's largest chip manufacturer. It saw a 16% year-on-year revenue rise, landing at $9.3 billion. And More Threads, which is NVIDIA's rival, saw 231% jump in revenue. U.S. export restrictions on entering China, such as the higher-grade NVIDIA chips, increased chips demand and amplified growth in China. Domestic players in China benefited from this, and they breached the gap. The U.S. export restrictions on high-bandwidth memory, which is a critical and a premium segment in AI, created opportunities for Chinese players such as Chongshin Memory Technologies. But there's risk of the overcapacity of less advanced chips. When the growth is so fast, inventory of less advanced chips might be left unwanted. And sustaining the fast growth will depend on whether China can successfully move up the value chain. Because now they're still lagging behind the bigger players. For example, the high-bandwidth memory market is dominated by Samsung, SK Hynix, and Micron. But overall, there's definitely a lot of opportunities in Chinese tech.